The Federal Reserve is poised to take interest rates to the highest level since 2000 at the upper bound, rates at 5.5%. For some perspective on when this could start to meaningfully slow the economy, let's bring in Diane Swonk, chief economist at KPMG. Diane, thanks so much for being with me. It's against this backdrop that we just got a fresh fruit of consumer confidence that's hitting a 2-year high. Is it because we haven't seen this long and variable lag of monetary policy show up yet?
Well, we haven't seen a lot of the impact on the labor market that the Fed thought itself it would see, and that's good news, of course. We have seen inflation also come down, and I think that's why you're seeing consumer confidence so high. What the Fed is going to be hedging against is, one, declaring victory too soon, and what they fear could be another acceleration in inflation or too high of a floor set on inflation later this year. And so they're going to get a hawkish hike. That means they're going to raise rates this week and pledge that they could leave the door open to additional rate hikes so that financial markets don't front run them and on rate cuts and ease financial conditions too much before they've already achieved their goals on a 2% inflation target.
The rhetoric has been very interesting to watch because coming into the year, the market was pricing in a situation of rate cuts that certainly the Fed was very keen to stamp out. How successful would you say the Fed has been in kind of managing those expectations and getting those people that believe that rate cuts are imminent out of the market?
Well, it certainly is a hard thing to do. What we've seen is the market, although they have been able to beat them back, the market has consistently priced in cuts, now pricing in cuts as soon as January. And I don't think that's what the Fed wants at this point in time. They are really worried about, they want to see real rates rise. That happens one of two ways, by raising interest rates and or by having inflation continuing to decelerate. What they're worried about is, like I said, hitting a too high of a floor on that. And I think they're very concerned about how quickly markets can undo a lot of the tightening that they've done. Remember, in the United States, bank credit, where the tightening has been the most aggressive, is only a third of overall credit conditions. The good news is we have seen inflation come down, but it's still not at a place where it's no longer distorting behaviors, and that's the Fed's ultimate goal.
It also comes down to the effectiveness of monetary policy. You hear this complaint about what can interest rates do about supply chain kinks, what can interest rates do about rising oil prices or whatever Russia and Ukraine are up to with respect to wheat. And another factor you're looking at is as medical costs as maybe a source of inflation surprise.
Exactly. Right now, the medical insurance component of the CPI, this is really kind of ridiculous. It's a quirk in the way that the measurement is done. It's down 25% from a year ago, helping those year-over-year numbers. And that's going to reverse come around October. Not only on a year-over-year basis, but also month-to-month, you'll see higher medical costs factored in the CPI measure of inflation. The Fed is well aware of that. That's why they don't want to take something as big as medical insurance and as big as medical costs off the table, because that is something they do feel they have to watch carefully. And remember, medical costs were the primary drivers of inflations for nearly 2 decades in the 1980s and 1990s. So I think what we're seeing out there is that the Fed is pleased that they've not gotten a hard landing yet, and that inflation, some of the things they don't have control about, have moved in their direction in terms of unwinding supply chains. But we know that demand was a factor here as well. And to the extent that we see an acceleration at the end of the year, if interest rates come down too much in the broader economy, besides what the Fed is doing, that's something the Fed wants to hedge against right now.
And you know, when you're talking about those kind of factors like medical inflation, another thing on the demand side I've heard people bring up is the fact that students will have to start paying their loans again come September as that moratorium lifts. How do you think about that as a meaningful driver of demand and possibly something that could meaningfully slow demand?
Well, it is a really large factor if everyone were to start repaying their loans. And of course, many people have lost the muscle memory of doing that over the last 3 years. And I think that's important. It's around $300 per month for about 30 million households, or 30 million borrowers out there, maybe a little less than that. And I think that's important to remember that there is a lot of changes in the way those student loans are going to be paid back. There are a lot of things that can help out student borrowers that should blunt the blow. And also, even to the extent of people who don't pay, not being penalized on their credit ratings in the first year in many cases. So that will also mean some people won't be paying it all back right away. That said, it is one of those factors that could add to a more meaningful slowdown in the fourth quarter. And that's what the Fed will be watching carefully on whether or not they need to do yet another rate hike. Another thing they don't have in their control are the number of strikes out there, and particularly a strike with package delivery crossing the
Yes.
UPS lines. If we do get a strike there, that could add to inflation in the supply chain as well.